Imagine waking up tomorrow to discover that the money in your bank account, the savings you've worked your entire life to build, the investments you thought were secure, have suddenly lost half their value overnight. Not because of a stock market crash, not because of a recession, but because the very foundation of global finance, the US dollar, the currency that has ruled the world for over 7 decades, is being challenged, dethroned, and replaced by a new power rising from the East. And this isn't some distant hypothetical scenario or a conspiracy theory whispered in the shadows of the internet. This is happening right now as Xi Jinping, the president of China, the world's second-largest economy and a nation with over 1.4 billion people, has made it crystal clear in recent statements, diplomatic meetings, and strategic moves that China intends to replace the US dollar as the global reserve currency with the yuan. And if you think this doesn't affect you, if you believe this is just political theater or economic posturing between superpowers, then you need to understand that every single aspect of your financial life, from the price of gas you pump into your car, to the cost of groceries at your local supermarket, to the interest rates on your mortgage, to the stability of your pension, to the value of your retirement funds, is tied directly to the dominance of the dollar. And when that dominance falls, the shockwaves will be felt in every corner of the planet, in every household, in every economy. And the terrifying part is that the mechanisms for this seismic shift are already in motion. The alliances are being formed, the infrastructure is being built, and the global financial order as we know it is being quietly, systematically dismantled piece by piece. Let's be absolutely clear about what's at stake here. Since the end of World War II, the US dollar has been the undisputed king of global currency. The Bretton Woods Agreement in 1944 established the dollar as the world's reserve currency, meaning that countries around the globe hold dollars in their central bank reserves. International trade is conducted primarily in dollars, oil and commodities are priced in dollars, and this gives the United States an extraordinary power that no other nation possesses: the ability to print money and have the world accept it as valuable, the ability to impose economic sanctions that can cripple entire nations, the ability to control global financial flows, and the ability to essentially export inflation to other countries while maintaining its own economic stability. But this dominance comes with enemies, rivals, and nations that have grown tired of living under America's financial thumb, and China is leading the charge. Xi Jinping isn't just talking about replacing the dollar in abstract terms or academic discussions. He's actively building the architecture to make it happen. And the latest developments are nothing short of alarming for anyone who benefits from dollar dominance, which includes most Western nations, and particularly the United States itself. In recent high-profile speeches and meetings, including gatherings with leaders from the BRICS nations, Brazil, Russia, India, China, and South Africa, Xi has been explicit about his vision for a multipolar financial world, one where the yuan sits at the center of trade between Asia, Africa, the Middle East, and Latin America, effectively creating an alternative financial ecosystem that operates independently of Western institutions like the IMF, the World Bank, and the SWIFT payment system that America controls. What makes this particularly dangerous for dollar dominance is that China isn't acting alone. They're building a coalition of nations that have their own grievances against the U.S. financial system, countries that have been sanctioned, economically pressured, or simply marginalized by Washington's policies. And this coalition is growing rapidly. The BRICS alliance, which started as an economic bloc of 5 nations, has recently expanded with countries like Saudi Arabia, the United Arab Emirates, Egypt, Ethiopia, Iran, and Argentina, either joining or expressing serious interest. And when you look at what these nations represent, massive oil reserves, crucial trade routes, enormous populations, vast natural resources, and strategic geopolitical positions, you start to realize that this isn't a fringe movement. This is a fundamental realignment of global power, and the implications are staggering. Saudi Arabia's potential move away from the petrodollar system alone would be catastrophic for US dollar dominance, because since the 1970s, oil has been traded exclusively in dollars, forcing every nation that needs energy to hold dollar reserves, creating automatic demand for US currency and allowing America to run massive deficits without consequence. But if Saudi Arabia, the world's largest oil exporter, starts accepting yuan for oil, which they've already begun exploring through negotiations with Beijing, then the entire petrodollar system that has underwritten American economic hegemony for 50 years begins to crumble, and we're already seeing signs of this shift happening in real time. China has been systematically signing bilateral trade agreements with nations across Asia, Africa, and Latin America that bypass the dollar entirely, conducting trade directly in yuan or in local currencies, and they've sweetened these deals with massive infrastructure investments through the Belt and Road Initiative, a multi-trillion-dollar project that's building ports, railways, highways, and digital infrastructure across more than 140 countries, effectively creating economic dependencies that bind these nations to Beijing rather than Washington. And here's the brilliant, calculated strategy that Xi Jinping is executing. China isn't trying to replace the dollar overnight through some dramatic economic warfare. They're doing it gradually, systematically, making the yuan indispensable for trade, for investment, for development financing, so that when the tipping point arrives, when enough of the global economy is operating on yuan-based systems, the transition away from dollar dominance becomes inevitable, almost natural, and by that point, it will be too late for the United States to reverse course. Now let's talk about the weapons China has in this financial war, because understanding their strategy reveals just how serious this threat really is. First, there's China's massive manufacturing base. They're the world's factory, producing everything from smartphones to solar panels to pharmaceutical ingredients. And if you're a country that depends on Chinese goods, which is basically everyone, then trading in yuan makes logical sense. It eliminates currency conversion costs, reduces transaction times, and builds deeper economic ties with Beijing. Second, there's China's position as the world's largest trading nation. They've surpassed the United States in total trade volume with most regions of the world. And when you're someone's biggest customer and biggest supplier, you have leverage to dictate the terms of trade, including what currency gets used. Third, there's the digital yuan, China's central bank digital currency, which is the most advanced digital currency system created by any major economy. And unlike cryptocurrencies, which are decentralized and volatile, the digital yuan is backed by the Chinese government, fully controlled by the People's Bank of China, and designed specifically for international transactions, cross-border payments, and surveillance of financial flows. And China has been testing this system aggressively, conducting pilot programs in major cities, integrating it with mobile payment systems that hundreds of millions of Chinese citizens already use, and beginning to offer it as a payment option for international transactions. And the speed, efficiency, and low cost of digital yuan transactions compared to traditional dollar-based banking systems make it incredibly attractive for developing nations that have been underserved by Western financial institutions. Fourth, there's China's gold reserves. While official numbers from Beijing are always somewhat opaque, analysts believe China has been accumulating gold at unprecedented rates, potentially holding far more than the roughly 2,000 tons they officially report, and gold serves as the ultimate backstop for currency credibility. Because unlike fiat currencies that can be printed infinitely, gold is tangible, limited, and historically trusted. So if China eventually backs the yuan with gold or creates a gold-linked trading system, it would give their currency a level of trust and stability that could rival or even surpass the dollar, especially in times of economic uncertainty. Fifth, and perhaps most importantly, there's China's willingness to provide an alternative to the U.S.-dominated financial infrastructure. When America imposes sanctions, freezes assets, or cuts nations off from SWIFT, which has happened repeatedly to countries like Russia, Iran, Venezuela, North Korea, and others, those nations become desperate for alternatives, and China has built exactly that, creating alternative payment systems like CIPS, the cross-border interbank payment system, which allows for international yuan transactions without touching American financial networks, and expanding this system to more countries every year, essentially creating a parallel financial universe where the dollar is irrelevant and American sanctions are toothless. The strategy is comprehensive, multifaceted, and most terrifyingly, it's working. Yuan internationalization, once dismissed by Western analysts as impossible given China's capital controls and less developed financial markets, is accelerating at a pace that has caught many by surprise, and recent data shows that the yuan's share of global payments, while still far behind the dollar, has been growing steadily, particularly in Asia, where it's already the dominant currency for trade financing in several countries. And what's even more revealing is that central banks around the world have been diversifying their reserves away from dollars and into yuan, gold, and other assets, a trend that has intensified dramatically since 2022, when the United States and European allies froze Russia's dollar reserves following the invasion of Ukraine, a move that sent shockwaves through every non-Western nation, because it demonstrated conclusively that holding dollar reserves isn't safe if you're not aligned with Washington's foreign policy, and this weaponization of the dollar, while effective in the short term for punishing Russia, has accelerated the exact trend that undermines long-term dollar dominance because now countries like China, Saudi Arabia, Brazil, India, and dozens of others are actively working to reduce their dollar dependency, viewing it not as a neutral store of value, but as a political tool that can be used against them at any moment. The economic consequences of a yuan replacing the dollar as the global reserve currency would be absolutely catastrophic for the United States and transformative for the rest of the world in ways that are difficult to fully comprehend. For America, losing reserve currency status would mean the end of exorbitant privilege, the ability to run massive trade deficits and government debt without the normal consequences other nations would face, because right now the world needs dollars, so they're willing to lend to America at lower interest rates and accept dollars as payment even as the US prints trillions. But if that demand disappears, if the world no longer needs to hold dollars for international trade, then suddenly those trillions of dollars held in foreign reserves, in central banks, in sovereign wealth funds, could come flooding back to America, creating hyperinflation, a currency crisis, skyrocketing interest rates, a collapse in living standards, and economic chaos that would make the 2008 financial crisis look like a minor recession. And the U.S. government, which currently borrows at historically low rates precisely because of dollar dominance, would face impossible choices/spending. Dramatically raise taxes to unbearable levels, or print even more money and accelerate the inflationary spiral. For American consumers, the impact would be immediate and brutal. Import prices would surge because suddenly Americans would need to exchange weakened dollars for yuan or other currencies to buy goods from China and other nations, meaning everything from electronics to clothing to household goods would become vastly more expensive. And since America imports far more than it exports, this would represent a massive decline in purchasing power and quality of life for hundreds of millions of people. For the U.S. military and geopolitical power, the impact would be equally severe because American military dominance is built on economic dominance. The ability to fund a massive defense budget, maintain bases around the world, project power globally, all depends on the financial advantages that come with the dollar being the reserve currency. And if that economic foundation crumbles, America's ability to maintain its military empire crumbles with it, potentially triggering a rapid decline in global influence and a power vacuum that China would eagerly fill. For the rest of the world, the picture is more complex and varies dramatically depending on each nation's relationship with China versus America. Developing nations that have been repeatedly hit by dollar-based debt crises where they borrow in dollars but earn in their local currencies and then get crushed when the dollar strengthens might actually benefit from a more multipolar currency system that gives them more options, more flexibility, and potentially more favorable terms from Chinese lenders who are competing with Western institutions. And indeed, this is part of China's pitch. They present themselves as a more equitable partner, one that doesn't impose political conditions, doesn't lecture about human rights or democracy, and simply wants mutually beneficial economic relationships, which is incredibly appealing to governments that have grown tired of Western interference and condescension. For Europe, the situation is particularly precarious because the European Union is caught between the declining American empire and the rising Chinese one. And while the euro is theoretically a competitor to both the dollar and yuan, in practice, Europe lacks the political unity, military power, and economic dynamism to truly challenge either, and European leaders are deeply divided about whether to align with Washington or Beijing, with countries like Germany having massive trade relationships with China while simultaneously being part of NATO and dependent on American security guarantees, creating painful contradictions that will only intensify as the dollar-yuan competition escalates. For countries like Russia, Iran, Venezuela, and others that have been sanctioned and isolated by the West, a yuan-based alternative system is an absolute lifeline, allowing them to conduct international trade, access financial markets, and sustain their economies despite American attempts to strangle them. And this is why you see deepening alliances between Beijing and these pariah states, because China offers them something Washington never will: economic engagement without political demands, and this creates a powerful bloc of nations that are actively hostile to U.S. interests and working together to undermine dollar dominance. The oil trade dynamics are particularly crucial to understand because energy is the foundation of modern economies, and whoever controls energy trade controls enormous leverage over the global system. The petrodollar system, established through agreements between the United States and Saudi Arabia in the 1970s, has been the cornerstone of dollar dominance for half a century. Every nation that needs oil, which is every industrialized nation, must hold dollars to purchase that oil, creating automatic demand for U.S. currency and allowing America to run deficits that would bankrupt any other country. But this system is now under unprecedented strain as China, the world's largest oil importer, has been negotiating with Saudi Arabia, Russia, Iran, and other major producers to conduct oil trade in yuan. And these aren't just preliminary discussions. Actual yuan-denominated oil transactions have already occurred, setting precedents and establishing infrastructure for what could become a new petro-yuan system that mirrors or eventually replaces the petrodollar. And if that happens, if a significant portion of global oil trade shifts to yuan, then the foundation of dollar dominance collapses, demand for dollars plummets, and the economic and geopolitical implications cascade across every aspect of international relations. The sanctions weapon that America has wielded so effectively for decades would also lose much of its power because sanctions work primarily by cutting targets off from the dollar-based financial system. But if an alternative system exists, if countries and companies can conduct business in yuan through Chinese banks and payment networks, then American sanctions become more of an inconvenience than a death sentence. And this is already happening to some degree with Russia, which has managed to sustain its economy despite unprecedented Western sanctions by pivoting trade to China, India, and other nations willing to use alternative payment systems. And while Russia's economy has certainly been damaged, it hasn't collapsed the way many Western analysts predicted, precisely because alternatives to the dollar system exist and are growing more robust. The digital yuan represents a particularly fascinating and terrifying dimension of this competition, because it's not just about replacing paper dollars with paper yuan, it's about creating an entirely new technological infrastructure for global finance, one that China controls, and the efficiency gains of a well-designed central bank digital currency are substantial. Instant settlement of transactions, dramatically lower costs, transparency for governments that want to track money flows and prevent money laundering or tax evasion, and the ability to program money with specific conditions or expiration dates, creating new tools for monetary policy that were never before possible. And China has invested billions in developing this technology, testing it extensively, and is now rolling it out to partner nations, particularly in Southeast Asia and Africa. And the genius of this strategy is that once nations adopt Chinese digital currency infrastructure, they become locked into China's financial ecosystem dependent on Chinese technology, Chinese banks, Chinese payment systems, creating network effects that make it increasingly difficult to switch back to dollar-based systems. The responses from America, Europe, and international financial institutions like the IMF and World Bank have been a mixture of denial, dismissal, and belated panic, because for years, Western economists and policymakers insisted that the dollar's dominance was unassailable, that China's currency could never be trusted due to capital controls, lack of financial market depth, and authoritarian government control, but these arguments are increasingly hollow as the reality of shifting global power becomes undeniable. And while the Federal Reserve and U.S. Treasury have begun exploring their own digital dollar, they're years behind China in development and implementation, hampered by political divisions, regulatory concerns, and privacy debates that China's government simply doesn't face. And European leaders, caught between maintaining the transatlantic alliance with America and protecting their economic interests with China, have largely tried to play both sides, making vague statements about strategic autonomy while lacking the political will or economic power to truly chart an independent course. The IMF and World Bank, institutions that have been dominated by Western powers since their creation, are facing an existential crisis as alternative institutions emerge, particularly the Asian Infrastructure Investment Bank and the New Development Bank, both led by China and offering financing without the strict conditions that IMF loans typically impose. And developing nations are increasingly choosing Chinese financing over Western financing specifically because it comes with fewer strings attached, no requirements for austerity, privatization, or political reforms, just economic agreements, and this is causing a fundamental shift in global development finance that undermines the leverage Western institutions have wielded for decades. Global markets have been reacting to these developments with increasing volatility and concern, with sophisticated investors beginning to diversify away from dollar-heavy portfolios, moving into gold, real estate, commodities, and yes, even yuan-denominated assets, while currency traders are paying close attention to every move by the People's Bank of China, every trade agreement that includes yuan settlement, every statement by Xi Jinping about financial sovereignty, because they understand that if the trend continues, if the momentum toward yuan internationalization accelerates, then the investment implications are enormous, potentially the biggest shift in global finance in a century, and being on the wrong side of that shift, being overexposed to dollar assets when the transition accelerates, could mean devastating losses, while correctly anticipating the shift and positioning accordingly could mean generational wealth. The timeline for how this unfolds is genuinely uncertain, and this is where analysis requires both careful attention to trends and humility about predictions, because currency regime changes are complex, historically rare, and dependent on countless variables including economic performance, military conflicts, technological disruptions, political decisions, and unpredictable events that can accelerate or derail trends. But what we can say with confidence is that the process has begun. The infrastructure for an alternative to dollar dominance is being built. The coalition of nations supporting that alternative is growing, and the structural forces pushing toward a multipolar currency system are strengthening rather than weakening. Some analysts believe we could see a major crisis that forces a rapid restructuring of the global currency system within the next 5 to 10 years, potentially triggered by a U.S. debt crisis, a conflict over Taiwan that disrupts global trade, a collapse in confidence in dollar assets, or some combination of factors that creates a sudden shift, while others argue that the transition will be gradual, taking 20 or 30 years, with the dollar slowly declining from dominant reserve currency to one of several major currencies used in international trade, sharing the stage with the yuan, euro, and possibly other currencies, or even some form of digital asset or basket of currencies. But regardless of the exact timeline, the direction of change seems increasingly clear, and pretending that dollar dominance is eternal, that the monetary system that emerged from World War II will last forever, is increasingly divorced from the reality of shifting global power. What happens next depends enormously on decisions made in Washington, Beijing, and capitals around the world over the next few years. Will the United States take aggressive action to defend dollar dominance, possibly through military means if Taiwan becomes a flashpoint? Or will American leaders accept a gradual decline and try to manage it as smoothly as possible? Will China push too hard, too fast, triggering a backlash and coalition against them? Or will they continue the patient, systematic approach that has been working? Will a major economic crisis force a sudden restructuring, or will the transition be gradual enough that most people don't fully notice until it's already happened? Will Europe find a way to assert itself as a genuine third pole in this competition, or will it remain divided and ultimately subordinate to whichever power proves dominant? Will emerging technologies like blockchain, artificial intelligence, or quantum computing disrupt the entire framework we're discussing, creating possibilities we haven't even considered? These are the questions that will define the global economy for decades to come, and the answers will determine not just which currency is used for international trade, but which nations wield power, which systems of governance prove most successful, and what kind of world our children and grandchildren will inherit. For individual citizens trying to make sense of all this and prepare for potential disruptions, the implications are both macro and deeply personal. Understanding that we're living through a potential transition between monetary systems, between global hegemonies, between entire eras of history, should influence how we think about savings, investments, career decisions, where we live, what skills we develop, and how we prepare for an uncertain future. Because if the dollar does lose its reserve status, the economic disruptions will touch every aspect of life in ways both obvious and subtle. And while we can't predict exactly how events will unfold, we can educate ourselves, stay informed, diversify risks, and maintain the flexibility to adapt as circumstances change. And most importantly, we can recognize that the financial system we've lived under our entire lives, that seems so permanent and natural, is actually a historical contingency that emerged from specific circumstances and could be replaced by something entirely different within our lifetimes. The stakes in this competition between the dollar and yuan extend far beyond economics and into the realm of geopolitics, military power, technological dominance, and even ideological conflict between different systems of governance, a world where China's currency, and therefore China's power, is ascendant, would likely be a world where authoritarian state capitalism is seen as more successful than democratic market capitalism, where individual rights are subordinated to collective goals as defined by the state, where surveillance and control are accepted as normal parts of economic life, and where international relations are explicitly transactional rather than based on shared values or principles. And whether you find that vision appealing or horrifying, it's what's at stake in this competition. And American leaders, whatever their many flaws and failures, do represent a different model, one where rule of law, individual liberty, free speech, and democratic accountability still matter even if imperfectly implemented, and the question of which system proves more successful, which currency becomes dominant, will shape human civilization for generations. So when Xi Jinping calls for the yuan to replace the US dollar as the global reserve currency, he's not just making an economic statement, he's announcing China's intention to fundamentally reshape the world order with China at its center. And the fact that he's saying this openly, that China is pursuing this goal systematically, and that they're making measurable progress should be a wake-up call to anyone who cares about the future, because the comfortable assumption that the West will always dominate, that the dollar will always reign, that American power is permanent, is being challenged like never before, and how this challenge plays out will be the defining geopolitical story of the 21st century, affecting everything from the price of groceries to the probability of global conflict, from the freedom of the internet to the surveillance capabilities of governments, from the prosperity of nations to the daily lives of billions of people who may not even realize that the currency system that underpins their entire economic existence is shifting beneath their feet. Disclaimer: this content is for educational and informational purposes only and is not intended as financial, investment, political, or any other form of professional advice. The analysis presented represents research and opinion on geopolitical and economic trends and should not be used as the sole basis for any financial decisions. Always consult with qualified professionals before making investment or financial decisions, and conduct your own thorough research. The views expressed do not constitute recommendations to buy, sell, or hold any assets or currencies, nor do they represent predictions of future events or guaranteed outcomes.